You know, when most people hear the word investing, they imagine something complicated, technical, and reserved for experts in expensive suits sitting behind glowing screens. They think success in the market belongs to people with insider information, advanced math skills, or perfect timing. Benjamin Graham spent his entire life proving that idea wrong. He believed that investing at its core is not about intelligence or prediction. It is about behavior. It is about how you act when uncertainty appears, how you think when fear spreads, and how disciplined you remain when emotions try to take control. Benjamin Graham was born in 1894, long before stock apps, financial television, or social media hype. He lived through events that would test even the strongest nerves. The Panic of 1907, World War I, the Roaring Twenties, the Great Depression, World War II, inflationary decades, and repeated market collapses. He saw fortunes vanish in months and watched intelligent people lose everything because they ignored basic principles. These experiences shaped his philosophy and led him to a simple but powerful conclusion: markets are driven by human emotion far more than by logic. Especially in the short term, Graham understood something that most investors still struggle to accept. The stock market is not a precise measuring tool on a daily basis. It is an emotional arena. Prices move not because businesses suddenly change overnight, but because people do. Fear, greed, excitement, and despair push prices far above and far below what businesses are actually worth. Graham realized that if you could separate price from value, you could protect yourself from the market's most dangerous traps. One of Graham's greatest insights was the idea that owning a stock means owning a business, not a lottery ticket. When you buy a share, you are buying a claim on real assets, real earnings, and real future cash flows. Yet most people ignore this reality. They stare at price charts, headlines, and short-term movements, forgetting that behind every stock is an operating business. Graham believed this mental shift alone could transform an investor's results. He often described the market as an unstable business partner, someone who shows up every day, offering to buy or sell his share at wildly different prices. Some days this partner is optimistic and demands a very high price. Other days he is depressed and offers to sell at a deep discount. Graham taught that the intelligent investor does not argue with this partner or try to predict his moods. Instead, the intelligent investor uses those moods to their advantage. When prices are irrationally low, you buy. When they are irrationally high, you wait. This way of thinking requires emotional strength, not brilliance. Most people do the opposite. They feel safe when prices are high and fearful when prices are low. Graham observed that human instincts are perfectly designed to fail in financial markets. We are drawn to what is popular and repelled by what feels uncomfortable. Successful investing demands that you resist these instincts rather than obey them. One of the most important principles Graham introduced was the margin of safety. This concept became the foundation of value investing. The margin of safety means buying investments at prices significantly below their true value, leaving room for errors, unexpected events, or temporary setbacks. Graham knew that no analysis is ever perfect. The future is uncertain and mistakes are inevitable. The margin of safety exists to protect you when things do not go as planned. Graham learned this lesson the hard way. Early in his career, he experienced devastating losses during market crashes. Those losses were not caused by lack of intelligence, but by insufficient protection. From that pain came wisdom. He realized that the goal of investing is not maximum profit, but survival. Only those who survive can compound wealth over time. Those who chase aggressive gains often disappear after a single major mistake. Another core belief of Graham was that speculation and investing are not the same thing, even though many people confuse them. Speculation is based on hope and price movement. Investing is based on analysis, value, and safety. Graham warned that speculation becomes most dangerous when it feels safe, when everyone believes prices can only go higher. History proved him right again and again. During market booms, Graham noticed a dangerous pattern. People stop asking what a business is worth and start asking how fast the price is rising. Discipline disappears. Standards are lowered. Risk is ignored. Then, when reality returns, the losses are severe. Graham believed the intelligent investor must define clear rules and refuse to abandon them, no matter how tempting the environment becomes. Graham also emphasized the role of temperament over talent. He believed that even average intelligence, combined with emotional discipline, could outperform high intelligence combined with poor self-control. Markets reward patience and punish impulsiveness. This is why many highly educated people struggle as investors, while some ordinary individuals quietly succeed. The difference lies in behavior, not knowledge. Debt was another area where Graham was uncompromising. He warned strongly against using borrowed money to invest. Leverage magnifies both gains and losses, but losses matter more because they can permanently remove you from the game. Graham believed that financial independence requires flexibility, and debt destroys flexibility. When markets fall, the leveraged investor is forced to sell at the worst possible time, while the debt-free investor can wait. Waiting, in Graham's view, was not passive. It was a strategic advantage. The ability to do nothing while others panic is rare and valuable. Graham believed that cash is not useless. It is an option. It provides safety, opportunity, and psychological comfort. During market crashes, cash allows investors to act when prices are attractive, rather than watching helplessly. Graham also believed diversification was misunderstood. Owning many investments does not automatically reduce risk if those investments are poorly chosen. True diversification, he argued, comes from owning sound investments purchased with a margin of safety across different industries and conditions. Blind diversification without understanding creates the illusion of safety, not real protection. Time played a central role in Graham's philosophy. He believed wealth is built slowly, not dramatically. Compounding works best when left undisturbed. Frequent trading, emotional reactions, and constant adjustments often do more harm than good. Graham encouraged investors to think in years and decades, not days and weeks. Markets reward those who respect time. One of Graham's most powerful teachings was his understanding of human psychology. He knew fear and greed would never disappear. Instead of trying to eliminate emotion, he taught investors to design systems that protect them from their own behavior. Rules, discipline, and valuation frameworks act as guardrails, preventing emotional decisions during extreme moments. Graham also accepted that not everyone wants to be an active investor. For those unwilling or unable to analyze businesses deeply, he supported a defensive approach focused on diversification, low costs, and long-term holding. His philosophy was flexible. The goal was not to impress others, but to achieve satisfactory results with minimal risk. The legacy of Benjamin Graham extended far beyond his own career. His ideas influenced generations of investors, most famously Warren Buffett, who credited Graham as the foundation of his thinking. Buffett adapted the principles, but the core remained unchanged. Buy with a margin of safety, think long-term, and control emotion. What makes Graham's work timeless is that human behavior has not evolved. Technology changes, markets evolve, but fear, greed, and overconfidence remain constant. Every market bubble and crash follows the same emotional pattern. Graham's ideas endure because they address psychology, not prediction. Graham believed investing should serve life, not dominate it. Money is a tool, not a scorecard. The purpose of wealth is security, freedom, and peace of mind. Chasing excitement often leads to anxiety, stress, and regret. Discipline leads to calm and confidence. He also warned against the illusion of certainty. No one can predict markets consistently. Those who claim they can are either lucky or dishonest. Graham taught humility. Focus on what can be known: balance sheets, earnings power, asset values. Ignore what cannot: short-term price movements and market forecasts. In the final analysis, Benjamin Graham's philosophy was not about beating others. It was about protecting yourself. It was about building a financial life that could withstand uncertainty, recessions, and emotional storms. His message was simple but demanding. Think independently, act rationally, and respect risk. If you step back and look at Graham's life, you see a man shaped by crisis, refined by failure, and guided by logic. He did not promise wealth without effort. He promised a framework that rewards discipline and punishes recklessness. That framework remains as relevant today as it was a century ago. In a world obsessed with speed, prediction, and excitement, Graham offers something radical: patience, caution, and reason. And those qualities, quietly and consistently, build lasting wealth.